Most people think becoming financially free means you need to be a genius investor, own rental properties, or get lucky buying the next Nvidia before everyone else. But honestly, most millionaires were built in a much more boring way. They bought great businesses, they kept buying during crashes, and they stayed invested long enough for compounding to completely change their life. That's it. People never reach that stage because they quit too early, chase trends, or panic during recessions. And right now, we're entering a completely different investing era than the one people were used to a decade ago. Artificial intelligence is changing productivity faster than the internet did. Semiconductors have become geopolitical assets. Cloud computing is basically digital real estate now. The biggest companies in the world are generating absurd amounts of free cash flow. And the investors who understand where the economy is actually moving are quietly positioning themselves before the next wave fully plays out. And honestly, the amount you need to start is much lower than people think. And after years of trying to outsmart the market, but the people consistently building wealth weren't predicting the future. They were simply owning the strongest parts of the economy and letting time do the heavy lifting. That completely changed how we invest. Low-cost index funds, broad diversification, dividend growth, and long-term exposure to innovation. Simple, but incredibly powerful. What actually creates wealth inside a portfolio? It's not just dividends or stock growth either. It usually combines three things together: consistent appreciation, growing dividend income, and reinvestment compounding. That combination becomes dangerous over time, because compounding accelerates when growth and reinvestment work together. The biggest wealth generators now are not old, slow-moving companies paying massive yields. It's businesses dominating technology infrastructure, AI, automation, semiconductors, cybersecurity, digital payments, and cloud systems. Those industries are likely to keep expanding for years because the world depends on them more every single day. That's why his Fidelity portfolio became heavily focused on modern long-term trends while still maintaining stability and income growth. And the first fund became the foundation of everything. Fidelity 500 Index Fund. This is the anchor. And honestly, despite all the S&P 500 is too crowded arguments online, this is still one of the most powerful wealth-building funds on Earth. Because the S&P 500 today isn't just banks and oil companies anymore. It comprises businesses that are becoming stronger during economic slowdowns because scale matters more than ever. During hard economic periods, smaller, weak companies struggle first. The giants survive. Sometimes they even grow faster because weaker competitors disappear. Dividend yield, around 1.3%. Historical long-term return, roughly 10 to 12%. That's why Fidelity 500 Index Fund takes 35% of the portfolio. Because long-term, America's strongest companies still dominate global markets. The next decade probably won't look exactly like the last one. And this is where most people make a mistake. They think buying only the S&P 500 automatically gives maximum growth. Historically, it's excellent. But today, some of the biggest growth opportunities are happening outside traditional large-cap exposure, especially in innovation-heavy sectors. So that's why we add Fidelity NASDAQ Composite Index Fund. And honestly, this became the portfolio's rocket fuel. Because whether people realize it or not, artificial intelligence is still in the early innings. Most companies haven't even fully integrated AI systems yet. Entire industries are about to become more automated. Chip demand keeps rising. Cloud infrastructure spending keeps exploding. Data centers are expanding globally. Cybersecurity becomes more essential every year. And almost all of that growth funnels through technology-heavy companies. That's why Ryan wanted aggressive NASDAQ exposure while still staying diversified through an index fund. Because even though companies like Nvidia, Microsoft, Amazon, and Meta look unstoppable now, leadership eventually rotates. Owning the whole index protects Ryan from betting everything on one company. And historically, technology revolutions created massive long-term winners despite short-term volatility. The internet boom did it. Mobile computing did it. Cloud computing did it. Dividend yield, around 0.5%. Historical long-term return, roughly 13 to 15%. That's why we allocated 25% here, enough to supercharge long-term growth, but not enough to destroy the portfolio during major corrections. Ryan learned this the hard way after owning several income stocks that looked amazing on paper but barely moved for years. The payouts stayed high, but inflation quietly destroyed the real value of the income. Meanwhile, strong dividend growth companies kept increasing both payouts and share prices. That changed everything. Because dividend growth investing creates a portfolio that pays more over time instead of staying stagnant. That's why Ryan added Fidelity Dividend Growth Fund. This became the portfolio's compounding income machine. The companies inside are usually profitable, mature businesses with strong balance sheets and pricing power. Not desperate companies trying to attract investors with oversized payouts. And honestly, these businesses tend to survive recessions better because they generate real cash flow consistently. That's important today because higher interest rates exposed weak businesses across the market. Companies overloaded with debt started struggling. Unprofitable growth companies got crushed. But quality businesses with earnings and cash flow kept surviving. Dividend yield, around 1.7%. Historical return, around 10 to 12%. This became 20% of the portfolio. But now we need one more thing: smaller companies with higher upside potential. Because historically, some of the strongest returns happen when small and mid-cap companies recover after difficult economic periods. That's where Fidelity Extended Market Index Fund entered the portfolio. This fund gives exposure beyond the S&P 500. More mid-caps, more small companies, more room for future expansion. And honestly, this part matters because eventually giant companies slow down. Dividend yield, around 0.9%. Historical return, roughly 9 to 11%. That's why this became another 10% allocation. Now Ryan is getting prepared mentally for volatility before it happened. Because every investor thinks they can handle a crash until their portfolio actually drops 30%. That's when emotions take over. People panic sell. They stop investing. They convince themselves this time is different. Meanwhile, disciplined investors quietly keep buying discounted shares. And historically, those periods created some of the best long-term opportunities ever. Ryan understood this because he studied previous cycles carefully. The dot-com crash looked terrifying. The 2008 financial crisis looked hopeless. The COVID crash felt like the world was ending. And yet broad index investors who kept buying through those periods often came out dramatically wealthier later. Now portfolio looks like this: 35% Fidelity 500 Index Fund, 25% Fidelity NASDAQ Composite Index Fund, 20% Fidelity Dividend Growth Fund, 10% Fidelity Extended Market Index Fund, 10% Fidelity International Index Fund. That last part mattered too. Now let's talk real numbers, because this is where most people finally understand the power of compounding. Scenario 1. Ryan starts small. Initial investment, $5,000. Monthly contribution, $500. Average annual return, 12%. After 10 years, portfolio value, around $122,000. Annual dividends, roughly $2,000. After 20 years, portfolio value, around $495,000. Annual dividends, roughly $8,000 to $10,000. Scenario 2. Ryan gets serious. Initial investment, $20,000. Monthly contribution, $1,500. Average annual return, 12%. After 10 years, portfolio value, around $390,000. After 20 years, portfolio value, roughly $1.5 million. Estimated annual income, $40,000 to $60,000 depending on yield growth. That's already approaching the $5,000 per month goal. Here Ryan starts thinking like an owner. Every paycheck became fuel for the machine. Every market dip became an opportunity to buy future cash flow cheaper. And every reinvested dividend quietly bought more ownership behind the scenes. That's when investing stopped feeling random. Real wealth usually looks boring while it's being built. Until suddenly, it doesn't anymore.